What's happening with the US dollar right now is catching a lot of attention, and for good reason. Unlike most currencies, the US dollar plays a unique role. It's not just America's currency, it's the world's reserve currency. Many see it as a safe haven, kind of like digital gold. But here's the twist. Over the past few months, the dollar has been losing ground. And that shift could have some major ripple effects, especially when you factor in policy moves like Donald Trump's proposed reciprocal tariffs. Before we dive in, kindly take a second to hit the like button. It really helps to support and to grow my channel and keeps us bringing you the latest market insights. Thank you. Take a look at this chart. It tracks the US dollar index, which measures the dollar's strength against a basket of global currencies, mostly the euro, but also others like the yen and the pound. Basically, it gives us a snapshot of how the dollar is doing overall. 1 month ago, the US dollar index was sitting at 104. That meant the dollar was relatively strong. But today, it's dropped to 99, a meaningful move. That's a 3.91% decline in just 1 month. Even in the last 5 days alone, we've seen a 0.79% drop. So what does this mean for investors? While some might panic, others see opportunity. A weaker dollar can boost exports, support multinational earnings, and even spark bullish momentum in commodities like gold, oil, and crypto. In short, this dollar dip might just be the setup smart investors have been waiting for. Over the last 24 hours, the US dollar index has dipped another 0.18%, continuing a consistent downward trend. And when you zoom out and look at the bigger picture, things get even more interesting. If we go back to the start of 2025, the dollar index was sitting at 109. Fast forward to today, and it's down to 99. That's a drop of over 8.5% just this year alone. And for a global reserve currency like the US dollar, that's a major move. Now, at first glance, this might sound like bad news. But for investors who understand macro trends, this shift could actually unlock massive opportunity. Here's why. Currency fluctuations directly impact the cost of imports and exports. A weaker dollar makes American goods cheaper for foreign buyers, potentially giving U.S. companies a competitive edge on the global stage. That can boost revenues for exporters, manufacturers, and even multinational tech giants. To break it down further, let's look at how this affects the real economy, starting with imports. This next chart shows the euro to dollar exchange rate over the past 6 months. Back in January 2025, the two currencies were trading nearly 1-to-1. The exchange rate was just above parity. So, for example, a European product priced at €100 would cost around $100 to bring into the US. But things have shifted. That same $100 product now costs $114, a noticeable jump for American consumers and businesses that rely on European imports. On the surface, that could increase prices on imported goods. But here's the bullish flip side. This creates more room for domestic producers to shine. When foreign goods become more expensive, local businesses gain an advantage. That can drive growth in U.S. manufacturing, retail, and even sectors like agriculture. And let's not forget commodities. Historically, a falling dollar often lights a fire under assets like gold, oil, and crypto, all of which tend to perform strongly when the dollar weakens. For investors watching this trend, that could mean it's time to reposition portfolios and ride the next wave of upside. So yes, the dollar is dropping. But for sharp investors, this isn't a crisis. It's a window of opportunity. We already know the dollar has been dropping, but when you zoom out, the trend is crystal clear. Back at the start of 2025, the US dollar index was at 109. Today, it's down to 99. That's a drop of over 8.5% in just a few months. Huge for a currency that's used around the world as a benchmark for value. So what does that actually mean? Let's look at a real-world example using the euro. At the beginning of 2025, the euro and the dollar were nearly at parity, almost 1-to-1. So a product made in Europe that cost €100 would have cost about $100 in the US. Simple. But now the euro has strengthened. The exchange rate is €1 to $1.14. That same €100 item now costs $114. That's a 14% increase in just 3 months, essentially imported inflation. And if you annualize that, multiplying it by 4, you're looking at a massive price spike. That's what's keeping economists and policymakers up at night. And that's not even factoring in the new reciprocal tariffs introduced by Donald Trump, which could drive prices even higher. Now let's go even deeper. Here's a look at the top 10 countries the U.S. imported goods from in 2024 and the total value of those imports. Mexico, $510 billion. China, $460 billion. Canada, $422 billion. Germany, $170 billion. Japan, $157 billion. Vietnam, 143 billion. South Korea, 136 billion. Taiwan, 119 billion. Ireland, $108 billion. India, $108 billion. Those numbers represent a massive chunk of the U.S. supply chain. In terms of percentages, 15% of imports came from Mexico, 14% from China, 13% from Canada, 5% from Germany, 4.5% from Japan, 4.2% from Vietnam, 4% from South Korea, 3.5% from Taiwan, 3.1% from Ireland, and 3.1% from India. Now, here's where it gets real for investors. With the dollar losing value, all of these imports are going to cost more. Based on current exchange rates, here's the estimated increase in cost due to the dollar's drop. Mexico, plus $20 billion. China, $18.5 billion. Canada, plus $16.9 billion. Germany, plus $6.6 billion. Japan, plus $6.1 billion, and that's before adding the new Trump tariffs. All of this is inflationary, yes, but here's the bullish angle. This could lead to a major shift toward domestic production and reshoring, which is great news for U.S. manufacturers and industrial stocks. It could also create a favorable environment for commodities, particularly gold, oil, and crypto, as investors look for assets that hold value during currency weakness. So while headlines might scream dollar in decline, savvy investors see what's really going on, a transition that could unlock new opportunities across multiple sectors. Now let's talk about the second major force driving prices higher: tariffs. Just to recap, here's where we stand right now under the current trade policy led by Donald Trump. Tariffs are sitting at 25% for Mexico and Canada, a massive 145% for China, and 10% for most other countries. But here's the important detail. These numbers are temporary, part of a 90-day pause in the full rollout of Trump's reciprocal tariffs. If trade deals aren't locked in before that window closes, we're looking at a much steeper set of tariffs coming into play. That would mean 20% tariffs for all European Union countries and tariffs as high as 90% for countries like Vietnam. If those rates go into effect, the cost of importing goods into the U.S. will rise dramatically. But even at today's paused levels, the numbers are already eye-opening. Let's break it down by country. For Mexico, the 25% tariff on $510 billion of imports adds $127 billion in additional cost. And remember, the weaker dollar adds another $20 billion on top of that. Total impact? Nearly $150 billion. For China, the 145% tariff could add $671 billion. Yes, that's $671 billion to import costs, assuming trade volumes remain steady. Add in the dollar impact, $18.5 billion more. Total impact? Just under $690 billion. Canada would see tariffs add $105 billion, and the currency shift adds $16.9 billion. Combined, over $122 billion. You can start to see what this means for the bigger picture. This is what we call a double whammy. On one side, the falling value of the dollar is driving up the cost of imported goods. On the other side, tariffs are adding even more pressure. That's a recipe for rising prices across the board. Now, this is exactly what Donald Trump wants. The idea is to make foreign goods so expensive that American consumers turn toward made-in-USA alternatives. In theory, this should boost domestic manufacturing, create local jobs, and keep money circulating in the U.S. economy. But here's the challenge. Supply doesn't appear overnight. You can't just snap your fingers and fill store shelves with American-made products. For many industries, it takes months or even years to scale up local production. In the short term, this could create shortages or pricing pressure. Still, for investors, this opens the door to major opportunities. Companies that are already producing in the U.S. could see a boom in demand. Domestic manufacturers may gain pricing power and market share. Sectors like infrastructure, logistics, and automation could benefit as supply chains shift back home. Right now, U.S. businesses simply aren't ready to meet the full demand of the domestic market. Production hasn't scaled up fast enough. So in the short term, American consumers are stuck between two tough choices. One, stop buying altogether or keep buying imports and pay much higher prices. And it's not just tariffs driving those prices up. There's also the sliding value of the U.S. dollar, which is making every imported item even more expensive. Put it all together, and we're looking at a strong wave of inflation heading toward the U.S. economy. And here's the real issue. If inflation spikes, the Federal Reserve will be forced to step in. That likely means raising interest rates, which could slow down the economy even while prices keep climbing. That's the classic definition of stagflation. Rising prices plus slowing growth. And it puts policymakers in a tough spot. But let's flip the script because not all the news is bad. A weaker dollar also makes U.S. exports cheaper for global buyers. That's a massive advantage for American companies already selling overseas. Think about it. If you're a buyer in Europe or Asia, U.S. goods just got more affordable. That could open up new markets and boost profits for American exporters. But there's a catch. Let's take China, for example. In 2024, U.S. companies exported around $180 billion worth of goods to China, making it one of America's most important trade partners. Despite the trade gap, that's still a huge market with 1.4 billion consumers. Yes, there's always chatter online about population conspiracies, but the fact is, China remains a critical customer base for American-made products. Now, here's where the challenge comes in. Because the U.S. slapped a 145% tariff on imports from China, China has hit back. They've responded with 125% tariffs on all U.S. goods headed their way. Additional policy measures that make it tougher for American companies to compete. So even though a weaker dollar should help U.S. companies sell more abroad, those benefits are being erased by aggressive retaliatory tariffs. A product might be cheaper in dollars, but when you add 125% in Chinese tariffs, it becomes way too expensive to sell competitively. That's the reality exporters are facing right now. But here's the bullish angle. Massive change means massive opportunity. The pressure from tariffs and currency shifts is pushing companies to rethink their entire strategy. U.S. businesses that lean into reshoring, automation, and innovation could come out on top. Exporters who diversify beyond China or who build partnerships in friendlier markets will be in a prime position to grow. And sectors that support domestic manufacturing, from logistics to raw materials to AI-driven production, are likely to see serious investment inflows. So while this environment may look unstable on the surface, smart investors know volatility breeds opportunity. And all of those things are going to be more expensive as a result of the tariffs. However, what we've looked at in today's video is that the falling value of the dollar, which is continuing to go down, will also make those imports more expensive. So we've got a double whammy here in terms of U.S. consumers. That's going to drive up inflation. And the big question is, what is the Fed going to do? Because if we're starting to see a global slowdown as a result of this trade war, we're already seeing markets becoming very nervous about what the rest of this year looks like. And that will mean that the U.S. economy will also slow down. And China hasn't stopped at tariffs. They've gone a step further, targeting specific U.S. companies and products. They're claiming some American goods don't meet quality standards, and they've started banning certain food products altogether. That's already impacted U.S. agricultural exporters, especially those selling niche products like chicken feet and pig's ears, which were in high demand in China. They're also introducing other trade restrictions aimed at slowing the flow of American goods into their market. So even though a falling dollar should be making U.S. exports cheaper, all these extra roadblocks are erasing the potential benefits. And it's not just China. We're now hearing from people in other countries who are choosing to stop buying American products entirely. Why? Because of the U.S. tariffs on imports. The sentiment is shifting. Just like the U.S. is stepping back from buying foreign goods, other countries are starting to do the same with American brands. This is about consumer sentiment, global positioning, and the reputation of American trade. So what's the big takeaway? The U.S. dollar is under pressure, that much is clear. It's dropped steadily since the start of 2025. And when the world's reserve currency starts to fall, it sends a message to markets everywhere. For years, the dollar has been the gold standard, the go-to option for global reserves. But that confidence is now being tested. Why? A big reason is the tariff-driven trade disruption led by Donald Trump. If the full slate of tariffs he proposed goes live, and there's a high chance it could trigger even more inflation and put massive stress on the U.S. economy. The issue is U.S. manufacturing isn't ready to step in overnight. You can't just flip a switch and replace $510 billion worth of imports with American-made goods. So even if the goal is to bring jobs home, the transition period could be painful. That means higher prices, reduced supply, and more pressure on everyday consumers. But here's where the investor opportunity comes in. These disruptions, while challenging, also create massive openings for savvy businesses and forward-thinking investors. Industries like domestic manufacturing, raw materials and infrastructure, tech-driven supply chain solutions, agriculture shifting to new markets, could all see major upside as the U.S. pivots towards self-reliance and trade diversification. And if inflation does spike, it could spark a new wave of investment into real assets commodities. gold, and yes, even U.S. equities tied to essential goods and services. The key is positioning. In uncertain times, money doesn't disappear, it just moves. And it tends to move toward resilience, innovation, and opportunity. So don't panic, prepare. The falling dollar, the tariffs, the global pushback. These are signs of a world in transition. And history shows that's when some of the best investments are made. In the past, U.S. policy changes, especially major ones, happened gradually. There was usually a clear process. Proposals, debates in Congress and the Senate, public input, and eventually, well-planned implementation. This gave markets time to adjust, businesses time to prepare, and investors time to position themselves. But now, in 2025, things are moving much faster and a lot more unpredictably. Case in point, Donald Trump recently announced sweeping tariffs almost overnight. Within a few days, he pivoted again, pausing the full rollout but still slapping on 10% tariffs across the board. This kind of back and forth is making investors nervous. Why? Because uncertainty shakes confidence, and confidence is what keeps currencies strong. The fear is that this unpredictable pattern will continue throughout 2025. If decisions keep getting reversed or adjusted on the fly, it could create real instability in the economy, especially in trade, supply chains, and investment strategy. But here's where we flip the script. Volatility drives momentum. While volatility and political uncertainty may rattle traditional markets, for investors, this can be a goldmine of opportunity. Why? Because volatility creates movement, and with movement comes momentum. We're now in a window where smart investors can front-run policy shifts. Domestic producers can capitalize on the tariff gap. Exporters can benefit from a weaker dollar if they're targeting the right markets. And traders? They're riding the dollar's moves with currency plays, commodity hedges, and emerging market positions. So yes, things are unpredictable. But if you've got your strategy dialed in, this isn't a crisis. It's a moment to move. Yes, the U.S. dollar is sliding. Yes, we're seeing trade shifts, rising import costs, and political curveballs. But here's the upside. Change creates opportunity. Smart investors know that when the market moves, wealth gets redistributed. And right now, we're in a moment where positioning yourself right could pay off big, whether that's in domestic growth plays, export-driven businesses, or tactical trades riding currency waves. The U.S. economy is entering a new chapter. And if you're paying attention, you're already ahead of the game. If this video gave you value, insight, or just something to think about, do me a favor. Hit that like button, share it with someone who needs to see it, and subscribe so you don't miss the next move before it happens. Thank you so much for watching. I'll see you in my next video.